Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Edward Smith, Asset Allocation Strategist for Rathbones. Hello, Edward.
Hello.
So despite the fact that the bookies are still odds on that we will remain in the EU after the referendum on June the 23rd, billions of pounds have come out of UK funds, which suggests that investors around the world are very nervous about this result.
I think that's right, and it seems that particularly US investors are withdrawing money from the UK and European funds. They tend to allocate sort of in a blanket fashion to Europe. They don't split out the UK and Europe like we tend to do. And I think that's right. You know, if you're a global investor, you can allocate your capital anywhere in the world. You're going to do so where there is less uncertainty. And if there's one thing certain about Brexit, is that it will breed uncertainty. And of course, our analysis suggests that there is a very high correlation between our measure of UK economic uncertainty and risk premiums on UK assets, particularly mid-cap equities and small-cap equities. So more uncertainty, higher risk premiums, everything else being equal, that means lower stock market prices.
So let's play devil's advocates then. Let's say that actually Britain does vote to leave the EU, and on the 24th, 25th, when we hear that result, what happens firstly to the economy and then secondly to the UK stock market?
Well, we think that, again, it's uncertainty that's the watchword. And uncertainty alone is enough to delay spending, it's enough to delay investment. And with the Chancellor's fiscal rules, that will almost certainly mean that the government misses its deficit reduction targets because of that reduction in spending and investment. So therefore, there will likely be another round of reduction in government spending and investment. So all of that will likely add up to a % or two off GDP over the first couple of years. Now, that's sort of our estimate of 1 to 2%. It's much lower than the Treasury's rather extreme assumptions of, 3.6 to 6%, which suffered from a few strange specifications in their model, in our opinion. But still, 1 to 2% off GDP growth over 2 years is quite a substantial amount in today's low growth world. And again, I think that will trigger more asset outflows from UK equities, regardless of what people think the long-term benefits might be.
And that has contagion risk, doesn't it? Because you specified there earlier that actually mid-caps and small caps are probably most at risk because they're most linked to the domestic economy. But actually, if people are tarring all UK equities with the same brush, we could well see the FTSE 100 dip as well.
I think certainly in the first few weeks that's quite likely, and I think that's really because of the reaction from global investors. Global investors don't tend to split out the UK and Europe, and we don't know if there's contagion from Brexit into Europe, into the likelihood of European disintegration, then that's yet another source of uncertainty that could just deter global investors, and they'll look for their returns elsewhere.
And there are certain sectors which are more vulnerable, aren't there? Things like banks and autos, which banks its regulation, and autos relies quite a lot on trade with the EU. Yes,
and whilst the tariffs that might be applied if we leave the free trade area are quite low on a weighted average basis, about 3.3%, nothing that's going to cause a collapse in trade there. For the auto sector, as well as textiles and agriculture, tariffs can be as high as 10-15% for autos, 20 to 30% for textiles and agriculture. So yes, investors have got to think about, okay, what companies are geared into not only those sectors but those supply chains as well. And banks, there is, for us, that is one of our key sources of risk from Brexit, and that's because of the direction of travel in European legislation and regulation. We've spoken to a number of lawyers and experts on the subject. They're unanimous that the EU is going to make it harder and harder to do financial services business in Europe from outside of its borders.
And let's say that the bookies are right and we do vote to remain. Does that mean perhaps there are opportunities in those areas which are looking risky if we leave?
Well, I think certainly the valuation multiples would suggest that. So the P multiple of the FTSE 250, if we plot that as a ratio to the P multiple of the FTSE 100, that ratio is pretty much at the lowest level it's ever been. So there's clearly a big valuation discount already being priced in to the FTSE 250 and also the FTSE Small Cap Index. And that could well present quite a substantial opportunity if we vote to remain.
Ed, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.